Welcome to Fundamentals, where I'm going to look at one of the most popular tracker funds on the AJ Bell Youinvest platform right now, namely iShares MSCI World ETF. An ETF is designed to track the performance of the underlying assets and deliver that performance minus any running costs. This particular tracker is following one of the broadest indices of all, the MSCI World. And just to be clear, MSCI is an organisation rather like FTSE, a company that produces indices and financial market data. The tracker has got over 1,600 individual stock holdings all told and over $8 billion in assets under administration. All things being equal, it should be pretty liquid, or easy to buy and sell at the price you want when you want it, at least under normal market conditions. iShares MSCI World uses physical, direct replication to generate performance, so it owns the underlying securities, which in this case are some of the world's very biggest companies by market capitalization: Apple, Microsoft, oil giant ExxonMobil, healthcare specialist Johnson & Johnson, and Amazon.com are the top 5 positions. Those names are all American, and that gives you a clue as to the geographic mix of the portfolio. The US is the world's biggest stock market, and American equities represent over 60% of the tracker's assets under administration, followed in order by the Eurozone, Japan, and then the UK. By sector, financial services, technology and healthcare are the key weightings, as we can see here. The tracker comes with a total expense ratio, annual expense ratio of 0.2%, and on this occasion it comes with accumulation units, so any dividends paid by the underlying stocks will be automatically reinvested. For those who care about these things, iShares MSCI World ETF comes with a 5-star Morningstar rating, and as a final point, it's one of the 14 trackers which make up the top trackers list provided by our investment guidance service. iShares MSCI World represents 14% of the cautious portfolio, 31% of the balanced one. So those are the mechanics. The question now is, why would your fellow investors be potentially buying today? And I think there are 3 possible reasons. First, global share prices are on a tear, inspired by the Trumpflation or reflation trade, whereby investors think US President-elect will be able to get growth and inflation going again with a package of infrastructure spending, deregulation and tax cuts. Inflation's generally bad for bond prices, and that may be prompting some investors to switch from fixed income, bonds, to stocks. Second, picking stocks is not easy, and the tracker provides instant diversification, which can be a way to protect your downside. With just one unit of the tracker, you get access to over 1,600 companies and a range of geographies. Third, it's cheap. That 0.2% total expense ratio is pretty competitive amongst trackers and a lot cheaper than most actively managed funds, where the fund manager makes the picks. However, the tracker won't beat the MSCI World, just follow it, whereas a good fund manager will be looking to provide premium returns to justify his or her fees. So that lack of outperformance is one potential catch with the tracker, and there are other risks. The tracker has done well since its 2009 launch, but as we can see from this chart, there have been plenty of lumps and bumps along the way. The risk of the odd downside lurch becomes even clearer if we look at the history of the underlying index, the MSCI World, over the last 2 decades. Plenty of ups and downs there. Shares, and it is shares at the underlying asset here, well, they're a long-term investment, and you must be able to ride out the downs as well as the ups. As such, be prepared for some large potential blips and try to build your portfolio so you don't have to access cash and sell at what could be an inopportune time, i.e. after one of those blips. So as with any investment, before you put any cash to work, you must therefore ensure that iShares MSCI World fits with your overall strategy, target returns, time horizon and tolerance for risk. And by tolerance for risk, I mean ability to withstand losses. Thank you for watching, and I look forward to seeing you next time.